Hello, I'm Heidi Johnson Bixby, and I'm here with Lynn Snyder, our portfolio manager. And it's our pleasure to be here on behalf of the Johnson Bixby planning team. As clients, many of you have been with us for a number of years, even decades. And I know, Lynn, you've experienced decades of the market, as have I. And when I think about the recent uncertainty that we've had in the markets, it gives you pause, doesn't it? Well, for us, what we look toward and what gives us peace of mind is, for Lynn, disciplined portfolio management. And we're going to talk about that in a little bit. And for me, from a planner perspective, we have a game plan in place for you and how those dollars are being allocated and used for your particular goals. And we also recognize the dollars, you hear about the markets, and we look at the dollars that we represent and how those dollars are getting affected in the view of what those dollars mean to you. So we understand that that is education for your kids or your grandkids. We understand that it is your retirement, your next vacation, your home purchase. There's a lot of things that those portfolios represent. And so today we want to spend some time providing you some information so that you have the same peace of mind that we do in the approach and our view on some of the things that are happening. Okay, Lynn, let's talk about the elephant in the room, tariffs. Okay, what is a tariff?
Great question. So in short, tariffs are a tax on imported goods.
Okay.
And so right now, the biggest concern around tariffs have been, we haven't seen tariffs at these levels that are being proposed in over 100 years. Unfortunately, the last time that tariffs were imposed at this level 100 years ago, that was part of what contributed to the Great Depression. Mm-hmm. The good news is we're seeing lots of negotiation around these tariffs, and the hope is not all of the proposed tariffs will ultimately come into place.
So there's proposals around a 25% tariff, but what does that mean to the average consumer?
Great question. So I think if we look at some economists out there who have done some of the fun math around tariffs.
It's fun to an economist, yeah.
Right now, they're projecting that at current levels, tariffs would be about on average 16 to 18% on all goods that we import into the country. The other piece of good news is, we are a big consumer economy. 70% of our GDP is driven by consumers. And we don't only consume imported goods, we consume some goods here in the US. So if we raise taxes on all of those imported goods to the current levels, that would equate to about a 2 to 3% sales tax on the average consumer.
Just for us to digest it on a personal household level, that 2 to 3% is what we would see increased expenses on pass-through costs to us on the goods that we're buying.
Correct.
And those are everything from, the vegetables that we get from Mexico to the toys that are manufactured in China, or clothing, any number of those items that we purchase.
Cars from
Europe. So a lot of it. So the other component of this that is talked about is inflation. And I know there's the Fed has been brought up also as a big elephant topic in the room to talk about. And so the Fed has a clear mandate. Let's talk about how the Fed's mandate, which you talk about that. I'll let you talk about that.
Great. So the Fed has a dual mandate. So their first mandate is to keep unemployment low, and their second mandate is to keep inflation down or within a reasonable level. Their target is 2%.
So with unemployment, one of their mandates being at the end of March is at 4.2%.
Correct.
That's at a really good place. So they're more focused on the inflation number.
Right now they are.
Yeah.
Yes. I would say, generally speaking, anything under 5% has historically been viewed as full employment.
Yeah.
So with unemployment at 4.2%, we're still in a very good place. It has been rising slowly, but still not the Fed's primary concern.
Yeah.
The bigger concern is that we've seen inflation above their 2% target for over now 3 years.
Yeah.
And so that's what they're focused on.
And so the correlation of the Fed being focused on the fact that inflation isn't coming down, but tariffs create a bit of concern about inflation, is why the Fed is not focusing on reducing interest rates.
Correct.
So that's the correlation between those two, which are a big topic of the news today.
Correct.
Yeah. So Lynn, we've talked a little about interest rates, but how does that specifically affect a portfolio? What are the pros and cons of that?
Yeah, great question. So the good news is, with interest rates being high, people who are invested in bonds are getting a nice coupon on their safe fixed income.
Which we haven't seen in 20 years?
We certainly haven't seen it over the last 15.
Yeah.
And so we've not seen this level of interest rates since the great financial crisis. So this is the first time we've been able to get this level of interest on the fixed income side of the portfolio. Mm-hmm. That serves two purposes. One, it gives you a nice return. So if interest rates stay where they are today, you can expect 5 to 6% returns on that part of your portfolio. Mm-hmm. The other good news is that if the economy does start to slow down and the Fed feels like they need to step in, you'll actually see that part of your portfolio offset potentially some of the losses on the equity side of the portfolio.
So some good news there.
Yes.
So from a consumer standpoint, you've probably noticed that you're actually getting some interest on your checking account. That hasn't happened in a long time either. This last year is the first time we've seen that in a long time. So whether you have it in a checking, savings, money market account, or able to buy a bond that's paying 4 or 5%, you're actually getting some interest that we haven't seen in a long time. There might be a downside, though, is if you're someone who's looking to get a mortgage, you're probably over 6% for a mortgage, and we have expected that those rates would have come down, but they're probably going to be elevated for a while yet. And so if someone's buying a mortgage, buying a house and having a mortgage, it might be that you still are able to buy the house, but you're going to have to recast that mortgage or refinance it when interest rates do come down. So Lynn, we've only had a few moments to scratch the surface on all the topics in the news. And one of the things that I hear, though, every time there's volatility in the market or something's happening, is it's different this time. And while I would say the headlines are different, there's always market volatility. That is always the same.
Unfortunately, it is. The causes are often different, but the volatility is very similar. So I will say, in any given year, we typically expect to see at least 10% pullback in the market.
Check, done it, check.
And we also expect to see 2 to 3, 5% pullbacks.
Check.
And last year, that was almost exactly what happened.
Yeah.
Every 5 to 6 years, we do expect to see potentially a 20% pullback. And certainly we've seen that this year. We didn't quite hit the 20% level on a closing day, but intraday, the markets were down 20% from their recent highs. The last time that happened was in COVID, which officially was 5 years ago. So in some ways, this
almost exactly March of 20
potential bear market is right on time.
Yeah. So as we said when we started, Lynn and I and our entire team have been through markets many times. And again, we want to say we are here for you. And we even appreciate many of you who have expressed thoughtfulness for us as we go through this. It is what we do, and we enjoy what we do and being part of your team. I hope you'll take the time to read in more detail Lynn's blog. A lot of good information in there that goes into more explanation about some of the dynamics. And so with that, we thank you. Thank you for being a client, and thank you for being on the journey with us and us with you.